With inflation sticking around, a lot of investors are now looking to use gold to try to safeguard their portfolios, or at least hedge against inflation. The precious metal reaching a peak of $2,010 in mid-2020 amid the COVID-driven slowdown. And now the world could be on the cusp of a recession. There's a growing number of investors expecting a breakout in gold prices this year. We've already seen them up quite a bit. Here to discuss is George Milling-Stanley, State Street Global Advisors Chief Gold Strategist. George, it's good to see you. You know, GLD, which of course is the ETF that you help manage, is up about 8.5% this year. We've had sort of concerns about the global economy before, including to some extent last year. What do you think is sort of driving this current push for gold prices to go higher?
Not sure there's anything really new here, Julie. We've talked about a lot of the reasons why gold has been at a fairly elevated level for a while. In fact, if you think about it, gold's been flirting with this $2,000 an ounce level for the best part of the past decade. It often takes a long time for a market to make a breakthrough into a new big figure, to move from the 1,000 and something to the $2,000 level. The $2,000 level has been a price at which a lot of people were happy to take profits for the best part of a decade. And that kind of a sentiment can get sort of embedded in the minds of investors. If it was right before, then it's going to be right this time and probably right next time. So I think we've seen a good deal of that lately. But it does seem to me, if there is something new in this equation, it does seem to me that there's definitely upward pressure with the fear of what could happen to the equity market if indeed we do tumble into a significant recession. And that seems to be the way the thinking is moving. The Fed has gone from talking about a soft landing to a soft-ish landing to this is going to cause pain, and they're now actually using the R word in Fed speak. And I think that's probably the new thing that has come into the equation. I think that's probably what's going to provide the impetus for prices to make that decisive break through the $2,000 level.
George, how has gold performed during past recessions?
Very, very well indeed. We've had 7 significant recessions in the last 50 years, which incidentally is the period I've been covering this market. So I've been there for all 7 of those significant recessions. The annual average appreciation in the gold price over all of those 7 recessions has been better than 20%. And remember that that's in a period when we're in recession. That's when equities are in negative territory, when bonds are going nowhere, when most of the other assets that you'd find in a typical portfolio these days are really suffering very badly. So gold in recessions at better than 20% annual returns, I think that's a really stellar performance. And that's the kind of performance that I'm expecting to see if indeed we are going into recession in the US and possibly globally over the next few quarters.
Of course, George, gold, you know, as much as any, if not more than other commodities, trades on this sort of global sentiment. But there's also supply and demand, like with any commodity. And I was just looking through the Newmont mining numbers today, which sort of highlighted as it tries to buy Newcrest to increase its capacity, it sort of highlights some of the supply constraints among the major miners as mining gets more expensive to get more gold out of the ground. Is that something that's sort of underpinning the gold price as well? What do you expect that dynamic to look like?
I'm really not expecting much in the way of change on the supply side of that dynamic that you're talking about, the balance between supply and demand. Basically, mine production goes up 1% or 2% a year, or it goes down 1% or 2% a year. It's not one of the major variables in that equation, the balance between supply and demand. What is interesting is the gold mining companies recently have been spending record amounts on exploration and development, and they're looking at brownfield sites around existing mines. It's always a good place to go exploring, but also greenfield sites where they've never been before. And at this point, they're simply not finding enough new ore bodies, new production in order to maintain production at the current level. And of course, what shareholders are looking for is growth, not sustained production. That's probably why the share prices of the mining companies have been somewhat depressed lately. But I think more interesting and more likely to be helpful for the price is what's happening on the demand side. You'll remember that during COVID, especially during 2020, but continuing into 2021, jewelry, which is more than half of a typical year's consumption, took a very, very serious hit. It dropped down to around a third of total demand instead of being better than half. We're now looking for a recovery. Most of that jewelry goes into the emerging markets. We're seeing a significant recovery in the Chinese economy now that they have finally abandoned the zero COVID policy. And as China's economy goes, so go the rest of the emerging markets in general. So we're looking for a significant rebound in gold jewelry consumption. We'll be seeing numbers from the World Gold Council for the first quarter at the end of next week. So we'll have a better handle on things then. But anecdotally, I'm hearing that jewelry has indeed shown signs of that rebound that we were looking for last year and didn't actually get. We get it this year. That's definitely going to be helpful for the price. On the investment side, and this is the other major component of demand, I'm not seeing any reduction in uncertainty. You mentioned the recession word. I think that is front and center in most investors' minds. Plus, of course, the fact that inflation, while it's wonderful, it's come down from 9% a year to 5%. If you go back 18 months, 5% would have been unacceptably high and impossible to contemplate. So there's no reduction in the anxiety that is fueling investor demand for gold.
George, sounds great for the bling bling trade out there. At the end of the day, too, I got to know, have you developed, a strong thesis on gold in the age of what has been called digital gold? And perhaps this is a much longer conversation. We only got 30 seconds here, but gold versus Bitcoin and how that stacks up.
Yeah, Bitcoin is very, very volatile. There are people who complain about gold as a volatile metal, but since Bitcoin was launched in 2009, its annualized volatility has been around 10 times the level of gold. I think that Bitcoin has identified itself, along with the big drop in assets last year, a drop of 2/3 in value. I think that Bitcoin has identified itself as just another risk asset. Gold still does offer protections against an awful lot of the things that investors are most worried about right now. Brad.
Thanks so much, George. George Milling-Stanley, who is the State Street Global Advisors Chief Gold Strategist. We appreciate the time and insights here today.